Now, the next stage is the early stage still, because your company is probably still small. But in some point in time, you probably have achieved what we call the break-even. If you can achieve cash flow break-even, that means, in theory, your company no longer requires any investment, and it can still continue on its own. But staying a small company is probably not what you want. I'm sure you want to expand and really make your company big and great. So if you want to expand your company after you have achieved probably break-even, or shall we call proof of concept, your concept is proven. You have shown people that customers are coming, customers are paying for your service, and you can sustain yourself. So how do you expand? Well, you probably will start thinking about opening your second shop, your 10th shop, or 100 shops. If you are actually a software or app services, you are starting to think about, I don't want to have just 10,000, 20,000 downloads. I want to have 100,000s. I want to have millions, or even tens of millions. I don't want to just support one language. I want to support multi-languages. Essentially, you are expanding your market. You might even think about expanding overseas. Have your first shop outside your home country. And now, any expansion would require a lot more investment. And at this stage, you are reaching a growth stage, probably a rapid growth stage. And here's where you would probably engage another type of investors. They are called the venture capitalists, or the VC for short. VCs love to invest in companies that are experiencing rapid growth. This is what they do very well. They want to find a company that they can help and finance them to grow rapidly. And to grow rapidly, indeed, needs a lot of money. So the VC typically will invest millions and millions of US dollar. Now, here's also a dilemma. If you are a startup and you have reached a certain size, you start looking for angel investment, which typically would be less than $1 million, or even 500,000, or even 200,000. And VC, by nature, they must invest multi-million dollars. Because for their size, and because they are running like a fund, they have to invest the money within a defined period of time, typically 3 years. And VC also have their own investors who give them a mandate of deploying all the money in the fund within 3 years as a typical timeline. But to do the due diligence and to find enough good company to spend time to do the due diligence is very challenging. And if you look at the time that they need to spend and the amount they are investing in each company and the size of a VC fund, soon you will realize VCs cannot invest in very, very small company. They must invest at least multi-million, sometimes 5 or even tens of millions of dollars. So if you find yourself in what we call the funding gap, for example, you are a small company, you're looking for maybe around 2 million US. It's a little bit too big for any angels, but it's too small for the VCs. This is a very, very difficult trap. So if you are somehow in this trap, you have to either ask for more money or you have to reduce the amount because you are neither here nor there. That's the funding gap, probably around 2 million US. So if all things go well and you have your VCs or more than one VCs to fund your multiple growth plan, you will reach an even bigger size because by now, after several rounds of VCs funding, you probably reach multi-countries, you probably have a lot of customers and a lot of downloads if you're running apps and software. And growth is going to be more difficult still because you cannot get growth by just growing organically, or it will be more challenging. You probably cannot continue to grow on a very rapid rate because you yourself have already achieved a certain size and you are kind of getting to be a giant. So for your next stage of growth, you will need even more funding. You might even be in a position to acquire other companies or even acquire your competitor. So you actually need even more funding to do so. And that's where we call the late stage, where another type of investor will come in. And they are called the private equity, PE for short. These kind of investment typically now would be at least like tens of millions, sometimes even 100 millions. And they will finance you to grow even further, bigger, or make a lot of acquisition. If you continue that path, you probably will reach some stage where it is time for you to get an initial public offering, IPO. So you're going to list on some exchange. And that's where you start actually getting the financing from public. Now, from an angel round to VC to PE, investors at some point are looking for an exit. Let's take angel investor as an example. I'm an angel investor. I invest in that initial stage. But at some point in time, if the next investors, be it the VC, the private equity, if they want to invest and buy out the previous investors and give the previous investor a decent return, multiple times of the investment that they put in, I will be very happy to get an exit with a decent return. If not, sometimes as an angel investors, we will sit through all the different investment rounds and eventually you get an IPO, and so we can also sell our shares in the market, and that's our return as well. As an investor, you are happy to get a decent return from any stage, from any other investors. Now, what we have just seen is a very typical curve or journey of a startup from the beginning to IPO or exit. Now, of course, it could also very well that at some point in time, someone decided to buy you out. Not just the funds, the PE funds or the VC fund, but it could be your competitor. It could be an established company that want to acquire your company for whatever reasons. It could be strategic reasons. It could be financial reasons that they want to acquire you. Again, that means that investors will be bought out and they will be happy to get a return on their investment. So this is a very, very typical curve that we have just shown.
Enjoyed it? Please follow our Patreon channel to learn more about international business, entrepreneurship knowledge, latest innovation, and scholars' insights, and even more. See you soon.